Good morning. So let's talk today about Bank of Canada expecting to raise their overnight rates by a quarter point and how this will affect you going forward with purchasing or possibly redoing your mortgage. This affects the variable loan rates. So I do want to clarify on that. Sorry about these weird hairs that are sticking up all over. Bond yields have been increasingly steadily rising over the last few months, and they continue to rise. So rates have increased over 300% in the last 15 months. This information was sent to me by one of the mortgage brokers that I work with. So I am just going to explain everything to you so it's easy to understand so you see where we are right now. We're still seeing strong house sales, values are increasing, and of course, rents are going up. And the housing market definitely has proven to be very resilient. And given all of the factors below, this is what we're facing. Immigration, biggest point, 500,000 newcomers came into Ontario alone in the last 12 months. That's a lot of people. And we don't have the infrastructure for it. This is equal to the traditional immigration target for all of Canada. So we saw in Ontario alone 500,000 people, which is double that of the population growth. Canada took in over 1 million people last year, 600,000 of which were non-residents, and many cannot buy, as I've stated before, due to the rules placed in January 2023. These numbers are expected to continue. New home starts are down each month. Financing for construction and development has almost tripled in 15 months, with commercial prime lending rate going from 2.45%, 6.95 up to 6.95, and soon to be 7.2%. This is a massive impact on us for housing, and you have to look at it from the perspective of developers. This is not a greed factor on their point. They are not going to build at these rates because people can't afford to buy the houses. This is going to cause a huge long-term ripple effect. And with our federal government allowing double into our country every year to what we have the infrastructure to support, this is going to cause a problem. Housing starts have decreased every year since 2021 and are continuing to decrease for the reasons stated above. Bond yields are going up across the board. So bond yields, they affect fixed rate mortgages, and we are nearing most mortgages qualifying at a minimum of 8%. That's a really scary number, especially when people have initiated their mortgages at 2% or less, 2.5, etc. Higher qualifying rates equal lower max mortgages you qualify for. So if house prices still stay high, people are not going to be able to afford to buy a home. So this is expected also to continue, especially with the job statistics from the USA, because we follow closely to the US, so you need to pay attention to that. Inflation remains high despite higher costs. Even though we've seen some decreases, we still need to see unemployment and higher debt loads to see a major drop in inflation. So what does this mean for you as my client? Well, they indicated a pause to interest rates in February 2023. And of course, Bank of Canada has changed its course based on their statements versus the actions we've been given, as well as the current economy. It's safe to say that you guys need to prioritize your cash flow and the ability to make loan payments over the timing the market and the interest game. So what that translates to is you need to buy something that you can afford. Don't try to time the market. It's of no benefit to you. You need to try to purchase, if you're looking to purchase, something that you can afford. The housing market has been very resilient. Buyers who are waiting, you've probably, as I've said before, you've probably missed the bottom. It kind of happened in December, January of this year. So if you are looking for a home, this is what I recommend. This is also validated by what the mortgage broker I work with deals with and what he also recommends. So if you already own a home and are porting or you're buying your first home, you need pre-approval and you need a rate hold. Let me repeat that. You need pre-approval with a rate hold. When rates increase, their pre-approval decreases. So remember that key factor if you're looking at purchasing a home. If you have a rate hold already, you should be good to go. But be cognizant of the rate hold expiry date. Remember that. Get a copy of the rate hold certificate. You will need closing to happen before that expires. Otherwise, your pre-approval may be affected. I know this is boring stuff when you're looking to buy a house, but these are the factors that allow you to be able to afford to buy a house. Buyers may see less competition on the market and have a better opportunity for buying their home at a lower price, which long-term can lead to greater savings, even with higher interest rates. I've said this countless times to my clients. I will say it again. You may have a better opportunity right now at buying for a lower price at a higher rate, which over the long term leads to greater savings, even with the rates being high. So don't be afraid of the rates being high. Buy what you can afford. For sellers, if you want to look for something, see if you can find a mortgage that's assumable. That would be an amazing thing. What about a vendor take back? Another amazing thing. If you have an assumable mortgage, that means you can take over the mortgage of the house that you're buying if you qualify for the same rate and the remaining term that the current owner has. This would be an amazing thing, especially for people that have signed in low. So this could be a massive value add to you if you're buying. And as a seller selling, massive value add or a vendor take back. Variable rate clients will see approximately a $15 rate increase per month for every $100,000 that they owe. So he's also stated TD, CIBC, RBC have static payments. Their payments mainly stay the same when the rate increases, but less goes towards the principal. Clients may be getting closer to their trigger rate, which is the point where they are paying all interest. And this is scary because I've heard of this happening. If this is the case, there may be given notice to have a large monthly increase just to bring it back in line. So be prepared for that. So here's the current best rates as of July 11th. 5.14 for 5-year. This is purchased with less than 20% down, 5.39 for 4, 5.74 for 3, 5.19 for 5. Purchasing with 20% down, it's so bizarre, 539, 5-year fixed to 589. So what I recommend is if you're in a variable and considering fixed and you may qualify for the first tier rates, current prime lending rate is 6.95. They are expecting it to go to 7.2% tomorrow. So schedule of announcements, Wednesday, July 12th. The next one after that will be September the 6th.